As we've been discussing, job growth remained strong in October, stoking fears around continuing inflation and, more importantly, continued interest rate increases. Because earlier this week, Jay Powell, chair of the Fed, described the labor market as overheated without any real signs of softening. He said it was premature to consider a pause from the central bank. Let's get to Goldman Sachs Asset Management's global fixed income and macro strategist, Gurpreet Gill, for more on this. Gurpreet, thank you for being here. We have been looking at the market reaction today on the equity side, which has been relatively strong. The read-through seems to be, I don't know what, that this report on the face of it doesn't seem to change the Fed's trajectory, right?
Hi, well, first of all, thank you for having me on. And I would say I agree with that. I wouldn't say that this report is going to change our outlook for the Fed, or indeed what the Fed officials think their outlook is at this juncture. The gain in non-farm payroll employment exceeded expectations, but actually, if you look on a historical basis, when you are in a tight labor market, companies tend to pull forward their hiring for the festive season. So that might explain the beat on non-farm payrolls relative to expectations. And then when you looked at the uptick in the unemployment rate, that was in part due to developments on labor force participation, but that data tends to be very volatile. So I don't think it is a game changer. Between now and the December meeting, we have 2 more CPI inflation prints and another labor market report. So that is the sort of top tier data that financial markets are going to be focused on.
Gurpreet, is a recession the only thing that might bring people who have been on the sidelines of labor force participation back into the workforce?
Well, the issues with labor supply are varied. So there was a structural element to it prior to the pandemic. The US had lower male labor force participation relative to other advanced economies for various reasons. As a result of the pandemic, as I'm sure you're well aware, some people exited the workforce for childcare reasons. Addressing that requires structural reform and policy. Some people, like in the UK, for example, are out with long-term sick due to COVID. Again, there's a lot of uncertainty around that. I wouldn't say that you necessarily need a recession to improve labor force participation. There are other ways to do that. But big picture, in the near term, the rebalancing of the labor market that is needed to bring inflation back to inflation target consistent levels is going to require a reduction in labor demand, because policymakers have sort of given up hope on the improvement in labor supply. And that's why we're very focused on what happens with job openings and what's happening in the labor market reports.
Gurpreet, how do you think the bond market will react in front of what looks to be another series of rate hikes coming?
Well, what's interesting is an analyst in my team was looking at fixed income spread markets in response to the 4 Fed 75 basis points rate hikes. And we've actually seen that those risk assets have largely become acclimatized to those pace of rate increases. And it was well flagged. And in July, actually, you saw a rally because there were hopes of a Fed policy pivot. So I think lots will depend on those 3 Ps that everybody is focused on right now, which is the prospect of a pivot, the pace of rate hikes, and that peak in the policy terminal rate. We think with the Fed, there is increased prospect of a downshift to 50 basis points, and we're going to move towards a slower pace of tightening, but potentially for longer. And that's actually consistent with past developed market central bank hiking cycles. In our view, actually, the rapid repricing in bonds is at the front end is largely behind us. And actually, we think it's a very opportunistic environment for investors to add exposure to high quality, short duration bonds. Lending to a high quality company or government for a short period of time is a very attractive alternative to the still very low rates that retail investors earn on bank deposits.
That's interesting, Gurpreet. And when we look at the benchmark 10-year, for example, how should we think about the relationship between the yield there and the Fed funds target rate? In other words, for example, if the terminal rate is 5%, what would that imply for the 10-year?
Well, we're in an environment where there are both cyclical developments at play in terms of what the Fed is doing to cool the economy to address inflation, and that is impacting the US yield curve and US rates. But big picture, we're also contending with structural inflation forces that imply that inflation is going to be higher than the last cycle. And so I would say where rates ultimately settle is still in flux. We, like the policymakers, have to be very data dependent. We have to be humble in our outlook and very nimble in adjusting our views and our expectations based on what the data is telling us. But I would say we do think that we are going to be transitioning into a higher inflation environment. For investors, the last cycle was all about low rates and this view of there is no alternative to riskier, higher yielding assets. But now we actually think it is time to bring on bonds, or BOB. So Tina's giving way to BOB, and there are opportunities in high quality, short duration assets, like I mentioned. But until we reach peak policy hawkishness, we do not think it is wise to have longer duration exposures.
Copy that. Thanks so much, Gurpreet. Good to get your perspective on this important day. Goldman Sachs Asset Management's global fixed income and macro strategist, Gurpreet Gill. Thank you.